The end-of-year AI bubble crash is cancelled. That's right. And perhaps in its place we'll get a far more favorable Santa rally. So buckle up for brand new all-time highs. There's really just one more thing that the buyers need to do, and it's pretty much a done deal. We're going there. This thing seems somewhat probable in the S&P 500. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points including this thing, and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got not just one, but 15 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY monthly time frame, talking about candle structure and location now that the November bars have officially closed out. In terms of structure this month, we certainly see a hammer-esque style bar. Now notably, to produce the lower wick, we needed selling pressure first, but buyers stepped up in a big way off the lows of the November range and are able to close in the upper third of the November range. Now we do still have technically a red-bodied bar, so buyers were unable to retake the opening print and expand range in the upward direction, but nonetheless, this is still bullish structure. And at the Trade Brigade, we take every candle at face value. I know many people would like to consider this a hanging man, but hanging mans, in my view, are not something that we should over-index on. If you take a look at these back-to-back hammers here, they technically resolved in the upward direction. If you look at this hanging man here, it resolved in the downward direction. If you look at this hanging man here, it resolved in the upward direction. So candle structure by itself, for me, is not enough to change my tone to being bearish on the monthly timescale. Quite the contrary. This actually looks more like a bullish bar to me, with the lower wick representing buying pressure. Now, if we pair this with location, the picture becomes even more clear. If we're thinking about bar-to-bar count, we've basically made a very nuanced lower high and a very nuanced lower low. For all intents and purposes, the range of the November bar is almost identical to the range of the October bar. And we also closed over the October close, which is quite notable. There was a very small amount of progress made from a closing basis in the upward direction. And as we know, the monthly trend is what matters most when we're evaluating the higher time frames. And we also know that this is the highest high in the trend count. So even if the monthly chart were to pull back, if this was going to be a hanging man candle and oh my goodness, the monthly chart is going to take a downturn, we know that there's really no sense in being overly bearish if we're holding on to this previous area of resistance as newfound support. Of course, if the chart looks like this, that would look like nothing more than a monthly high or low in hindsight. And as we know, bad things only happen, really bad things only happen when the monthly trend actually flips to down. And we do this exercise 12 times a year every single time we get a monthly close. As a reminder, here's the dot-com bubble bursting. You get monthly equilibrium via an equal high rather than a higher high. From here to here, you undoubtedly have a lower low. So the monthly trend has started to flip to down. This clearly is a lower high as well. Here's painful moment number 1 and painful moment number 2. Notice that all of this is taking place underneath a monthly 20 SMA, the orange moving average on the chart. If one example is not enough for you, take a look at the Great Financial Crisis. You have monthly equilibrium via this mostly equal high. You could call it a double top. That means your neckline is here. This is a lower high. This, of course, is a lower low. And then things get nasty and even nastier, which reminds me of the mantra that markets don't crash from the highs, they typically crash from the lows. Now, to get to the lows, you have to develop some sort of equilibrium and a change in trend of the monthly chart. Notice also here, the lower high underneath the now flattening monthly 20 SMA. If we go look at the current picture of the chart, it's not even close. There's no chance that in December, the monthly trend will, boom, in the blink of an eye, change to down. There's plenty of room for a monthly high or low here. We're not even close to the monthly 20 SMA. So on the higher time frames, I'm still absolutely bullish on this market. If we take a look at the weekly time scale and continue to move down through the time frames, you'll see a pretty compelling picture here as well. Let's start with candle structure. Solid green-bodied bar, no upper wick, no lower wick, strong close, smack on the highs of the weekly range. Now, admittedly, it was a holiday trading week with lighter volume. But if we think about what happened last week, or the week prior, I should even say, we had a breakdown from the inside candle range here. Recall that this bar closed underneath not just the inside candle low, but the engulfer low as well. Well, where did we close in terms of candle location in this last week's worth of trade? Over the breakdown bar high. So to me, that's starting to look much more like a bullish indication, and that this was nothing more than weekly equilibrium. The reason I say that is because, as we mentioned last Saturday, this was a pullback from the highest high in the weekly trend count, and what was required for a change in trend was a breakdown of the quintuple. Now it's quintuple after this low. It was quadruple, but now quintuple bottom low. And that simply did not take place. The 20 SMA on the weekly chart continues to act as support near this historical level, and we've closed over the previous breakdown candle high. Put yourself in the shoes of a seller. If you're a seller, what would you have preferred to see in the shortened holiday trading week? Maybe an inside bar that then threatens some kind of breakdown into this upcoming week to kick off December. It's not even a conversation point, remembering that we've closed up here almost on par with an equal high on the weekly. We're not quite there yet, but it's something to consider. I'll change my tone on the weekly timescale if this does end up being a double top, but what do we know about double tops? It's not a double top until it is, which will require the same exact breakdown. If the neckline's going to give way, you need to be underneath this 654, and given the close of last Friday, it doesn't seem like a top priority, at least early on in this coming week's worth of trade. We can come in here with a couple of indications as well, which support all of the claims we've made thus far. I do want to start with the April tariff lows to the all-time high as a reminder that on the monthly timescale, if the monthly chart were to pull back into that previous all-time high, it's the weekly 50 SMA as well as this fib 38.2, which is confluence for bullish support. If we clean this fib up and come in from this low up to this high, all of this has taken place over a fib 38.2 as we described last Saturday. That's unchanged and still bullish consolidation on this SPY weekly. We also brought into play a trend channel last week, and you can come in here and do something that's looking like this. And as we made note, this started to break underneath the trend channel low, but we didn't really have a firm breakdown there. You could draw that in slightly differently. You've kind of closed right at the trend channel low. If the market was going to become more bearish, you really would have wanted to see progress outside of the trend channel, not a snapback into the midpoint of the trend channel. So much more bullish here, sustaining that bullish look on the higher time frames. We can even come in with the other threats, which of course were the anchored VWAPs on the weekly. Not this previous week, but the week prior to that, the red-bodied bar, we had closed underneath 3 of the anchored VWAPs. Notice how this week we've taken back those 3 closes and we're above the entirety of the stack. The other threat on the weekly timescale was that we did see a close underneath the high volume node right over here. If we extend this off to our right, we closed underneath that, and once again, if you're a bear, just put yourself in the shoes of sellers. You want to see an inside candle underneath that shelf. You want to see an inside candle in the VWAP stack, and then this week, you want to be gunning for a breakdown of 654. If we just snap back to reality really quickly, what actually took place and what's possible going forward? Well, we could certainly now use this high volume shelf as a new area of support and continue the trend in the upward direction. Let's drop it on down to the daily time scale, where there's been a dramatic improvement as well. Let's start with a look at our weekly expected move. If you're not familiar with this study, it's the gray box right here, and you can check out the video tutorial in the top right-hand corner on how to set this up. If we're contained by the upper bound, the number's at 693.01, which is technically implying a higher high from last week, a higher high from this pivot, and a brand new all-time high as well. I don't know about you, but just that alone starts to side more with the bulls. If we look at the lower bound of the expected move, the number is 673.77. It's kind of meshed in there. And that is clearly a higher low over the bearish engulfer low from the Thursday session of now 2 weeks ago. So the expected move does strike me as being bullish. In the intro, I mentioned there's just one more thing that the buyers need to do, and it's directly related to the trend count here. In the Tuesday update video, what did we talk about? The trend was neutralizing via this equal high to the engulfer high, which was the ideal next lower high in the count, right? If we start from the all-time high, we had highs, all-time high, lower high. This was the next ideal lower high, rejecting the daily 20 SMA underneath the previous bearish engulfer from October 10th. And then ideally, all the sellers needed to do, put yourself in the shoes of a seller. They just wanted to see that inside bar. Any lower high in here would have kept the pressure on. We would be talking about left, head, right shoulder, and oh my goodness, weekly head and shoulders neckline break brings in a lower low, the market's bearish. That didn't happen, and we talked about this on Tuesday with the impromptu midweek market update video. When Tuesday closed over the 50, over the 20, over the opening print of that bearish engulfer high, we immediately neutralize on trend. Why? Because this is now an equal high on the daily timescale coming from the lowest low. So the trend isn't firmly up at that point, but is it up into the end of the week? I would argue absolutely, right? You now have a higher high. And I don't know about you, but a higher high does not fit into the definition of a downtrend. You need lower highs and lower lows. So the only thing that the buyers need to do here is stage a higher low anywhere, and I mean anywhere, over this level right here at 664.15, which might seem crazy, but it's possible. As long as a higher low, and of course the ideal higher low would look something like this, not going any further than the previous bearish engulfer high. But if the market does this, stages an hourly reversal off of that level, and then this, I mean, rock and roll. We're talking about a clean higher low from here to here. We're talking about that inverted head and shoulder situation we described on Tuesday, and we're all set, right? So the name of the game at the index level is to really not hang on to that bearish bias for any longer than we need to. And into the end of last week, even though it was a shortened session on Friday, even though you might not be a huge believer in the volume from Wednesday, it doesn't matter. The trend count has produced a new higher high. You could even come in with a trend line. You guys know me, I'm not a huge fan of trend lines. I much prefer the horizontals, but even a trend line here has been broken. So it does not make sense, once again, to maintain any more of a bearish stance than you have to. The higher time frame monthly, still bullish. The weekly, bullish, back in that trend channel, recapturing all of the anchored view apps over the high volume node. On the daily chart, reclaiming the 50, reclaiming the 20, reclaiming just the bearish engulfer high. It doesn't make sense to maintain an overly bearish stance here. Now, we've been straight up off the lows. So I think what we should talk about next is just kind of managing expectations. A pullback is a very reasonable outcome here. The market will not move in a straight line. So if the market pulls back and starts to flirt with this level, that's okay. That's actually probably healthier than just continuing in the upward direction with no stops, no pauses, no nothing whatsoever. This will allow stronger buyers to confirm the rally by stepping up at this previous area of resistance, using it as newfound support. If that's the golden spot, we'll see an hourly trend reversal there, and we'll start to reorient ourselves back in the upward direction, trading bullish outcomes rather than bearish ones. The one thing that you could maybe argue complicates things here is if the market does break down into this area and tries to stage a daily higher low. If you reject here, you might have to become more neutral once again on the chart and open-minded to just like, okay, let's take this day by day. We're back inside the chop zone. Let's maybe just dial back expectations on both sides. That is a possibility, but given the rally that we've seen and some of the supporting evidence we'll walk through today, I would still be slightly more optimistic looking for a daily higher low hold here to change the trend back to up. You're pulling back from the highest high in the trend count. There's just, again, put yourself in the shoes of a seller. This was a great bar on Friday, rejecting this previous area of support now acting as resistance. Okay, we're through it on Monday, but we can still reject the 50. We come in on Tuesday morning, and then it just, sellers had nothing to lean on here in the downward direction. The buyers just overwhelmed in a big way. And I was willing to give the sellers the benefit of the doubt all the way up here to the equal high, saying, okay, if we roll over, I probably want to reorient to the short side underneath something like 664.15, looking for this kind of outcome here. It just didn't happen. Wednesday and Friday, too bullish, making that higher high over something like 674. And once again, picture perfect looks like this. Still okay is something that looks like this. And we're really starting to target all-time highs, right? That's going to be up here at 689 and then beyond. If the market just continues in the upward direction, I would not be chasing new money longs right here, but I still would keep an open mind to looking for the first pullback. And, you know, the further, how should I frame this? The higher the market goes without a pullback, the better, because it's just going to allow for more room that any severe pullback is then structurally over the relevant area. So that's my take here on the daily. You can see, and another thing that I will continue to bang the table about is please just use Thursday's reference high as a gauge for relative strength and relative weakness. If you're looking at stocks that are still underneath that Thursday breakdown high, you are trading relative weakness. If you're trading stocks that are over that Thursday high, you're trading relative strength aligned with the broad market recovery effort here. Let's take it on down to the hourly chart. Let's talk about trend count and how the firm higher low needs to be established. You guys know that around the channel here, we use this concept of the hourly chart needing to flip into a downtrend to actually confirm a firm higher low. So what might that look like? If the market balances here, breaks, and sets a lower high, I would start to think, okay, hourly trend is flipping to down. When and if we approach this key level, I would then look for the hourly trend to reverse back to up, and that would be my signal to say, okay, this is your daily higher low here over the key inflection point. Once again, something like 673.75, lower edge of the weekly expected move, daily 20 SMA, bearish engulfer high 675. As long as that's the case, this is a primary outcome that I'm looking for in the coming weeks worth of trade. The hourly trend flips to down. We firm up a daily higher low here. The daily trend then solidifies back to up, and we're trying to navigate back to the all-time highs, something that looks like this. If the market just consolidates into a flag and then gets a Brigade bolt here, we'll start to go with that. I mean, intraday, if we can find the right risk reward for this style trade here, no problem. But it does become a little bit harder to trust the market coming from literally the low of the move to the all-time high with, this is vertical, right? This is a vertical move. Markets don't move in a straight line. I would become a little hesitant in chasing the highest high of this trend count without a pullback first. Remember, this was a lower volume week. It was a holiday week. That's fairly standard. If the market can come back with full strength, full volume, all of the participants at their desk on Monday, Tuesday, Wednesday, and if we firm up a higher low, that becomes really compelling. It's basically confirmation that, yes, the market is looking for continuation into the end of the year, and maybe we do get that Santa rally pressing new highs closer to maybe something like 7,000 SPX or 700 in the SPY here. The complicated factor that we've already described slightly is if the market flips into a downtrend here, but does not reverse into an uptrend on the hourly, right, on the hourly chart, and if we get something that looks like this, I mean, you could probably stage shorts through this thin structure retracement, right? What I find pretty compelling here is that on the Tuesday morning pullback, we used Friday's high as an area of support. So if we do start to see this, is it possible that here we can get that next flip of, instead of using this again as a new area of support, can we just use the Monday high as an area of support? Can we get some kind of pullback there to stage a higher low, in which case this is absolutely a bullish outcome? I would still be open-minded to this. If we can get a reversal here, you might just start to walk up your bullish odds as you get something along these lines. Notch the higher low, notch the higher low. If there is some kind of reversal here, the market comes in and we reject, that is where we take it day by day. We reevaluate the chart. I would probably have to see the context in which this market rejects here, what's happening with breadth, what's happening with the big players, what's happening with risk on versus risk off sentiment, what are the sectors doing? If that happens, we will reevaluate. But for now, base case, if I were to just draw this back in, and then we'll take a look at fibs as well as intraday anchored VWAPs, base case ideally looks like this. Daily higher low, navigating to all-time highs. If we balance and then break, it becomes a little harder to participate in. I would like to see a pullback here into the future and then some sort of continuation out of this market. If the market overshoots, the best place for a higher low is here, to then reestablish and take that move to the upside. Or we go a little bit deeper, we do support in here, and then we have to incrementally walk this back up and really be diligent about reevaluating what happens at the 674, 675 zone for the possibility of a lower high threat. Once again, we'll take that when and if it starts to occur. So those are the cases on the intraday. Let's take a look at the anchored VWAPs intraday. And what you'll notice is that the entirety of the stack is underneath us. The pink anchored VWAPs are from the bearish engulfer days. This is bearish engulfer on 1010. This is bearish engulfer on 1120. As long as we're above this stack, I would maintain a bullish edge, and I think it's fairly straightforward that that is going to coincide early on in the week with the upper range of those engulfers. I've said it until I'm blue in the face, but I think it's very, very obvious. A lot of people should be watching this in the market. 675, 674, 673, 75, that zone, very, very influential for the possibility of a higher low confirming the trend in the upward direction. We can come in here with the fibs as well. Notice, first of all, this is more than a 100% retracement of this move. That in of itself tells you that sellers don't have what it takes to really participate and drive markets lower. But if we come in now from the low up to the high, what you'll see is that right here at that key line in the sand, you do have that fib 61.8, which is a bullish indication. As long as we can hold that, that is the line in the sand, that's 664.15, that is where bulls stay in control of this market for a daily higher low. If we really are going to have to reevaluate, if we get something that looks like this, let's, like knock on wood that doesn't happen, because, and I don't think it should, based on some of the supporting evidence that we'll run through, but if this happens, we'll have to take it in stride. We will trade what the market presents to us. But for now, I would think that this is a lower probability outcome given everything that we're about to walk through. So speaking of walking through stuff, let's take a look. What's going on here with the market internals? Check out the video tutorial in the top right-hand corner. If you're not familiar with this dashboard, you could see all last week, even though it may not look like we had substantial volume in the index, you actually traded substantial volume flowing into the market at the exchange level. Notably on Tuesday, when the market made that full retracement up to the 1120 bearish engulfer high. Look at this volume flow moving up and over 300 million, right? Really substantial there, and really substantial considering it was holiday trade. I mean, that's something to write home about here into the Wednesday and half day Friday sessions. You could see the advanced decline line spends all of the week over the zero mark here, getting in-trend higher zone confirming on Tuesday, very close on that Wednesday session, and Friday is just kind of lackluster and flat. I wouldn't read into that too much. If we're thinking about the cumulative tick, also bullish all across the week. Now, I wouldn't sit here and say that it was substantial. Remember, 5,000 is substantial, but at the exchange level, there was much more buying pressure, as you can see, rather than selling pressure, which once again just strikes me as a bullish takeaway in the context of this massive reversal from the bearish engulfer. Once again, put yourself in the shoes of a seller. All you needed was a little bit of sell-side pressure to maintain a lower high, and the trend would have remained down, and it just didn't happen straight across the board. There was nothing for those sellers to really lean into. If we look at the market profile, it tells the same story. If you're not familiar with market profile, check out the video tutorial in the top right-hand corner. You can see here, value is higher on Monday, value is higher on Tuesday, value is higher on Wednesday. Even on Friday, the half-day session, value continues to progress in the upward direction with a point of control that is slightly higher. Now, I wouldn't look at this and say that the auction ended perfectly on the Friday session. It's a half day. So I would just sort of think about this high as being, maybe unsecure or poor, lack of material excess there. You didn't really have a big bang high. So, maybe the way to play this starts to just become, okay, if we take out value area low from Wednesday, that's where the pullback may start to step in. And then from there, we're just looking for a pullback into what? Well, it's really not that far away on the ES futures. 68.0650 is the bearish engulfer high from the 10-10 session. Okay, so that would be the key watch on the downside there. Market profile aligning more so with buyers rather than sellers. If you had stronger sellers, you wouldn't see these thin, drawn-out trend days in the upward direction where the market just grinded and found more value acceptance higher as opposed to lower in those individual profiles. Another clear takeaway, right, is on the Tuesday session in particular, notice that we had single prints on Monday. If you're a stronger seller, you want to battle for price acceptance in the lower distribution from Monday, and it just didn't happen. I mean, look at the close, firmly up here. Where's that little white arrow? It's hiding right there. So strong close, spike, spike high, and gap fill reversal, almost perfect on that Wednesday session. Sellers just don't have it going on here. And I think primarily it's two reasons. We've talked about this a little bit more fundamentally, but the AI bubble concerns kind of going away with Michael Burry's short position and the valuation of those NVIDIA chips being put to bed when Jensen in the earnings call quite literally said, no, the depreciation schedule is fine. And then you also have the Fed U-turn, right? The Fed pivot, let's just say Fed pivot, immediately spurred on a broadening out of the market rally. And we'll see this as we move into other indexes and other sectors, right? So let's just get back over here. Let's look at the NASDAQ from a monthly perspective really quickly. I won't go through the same exact, looking back at 08 and 2000, but there's your hanging man. A lot of people will say the same thing. Again, go back. Here's a hanging man, market resolved higher. You could say there's a hanging man, market resolved lower. That's possible. In here, hanging man, market resolved lower. How about this one? Resolved higher. How about this one? Resolved higher. So it's got too much of a mixed bag of a track record for me to really feel like it's anything influential. If we just quickly throw on, though, that 20 SMA, just want to point out that we're still so far above it, and this is easily an opportunity for a monthly higher low still in the trend count. There's really no threat of a reversal yet on the monthly. Let's get into our weekly chart for the NASDAQ side of things. You can see the same bar here, basically solid green bodied bar closing on the highs. It makes on the bar-to-bar count a higher low and a higher high, closing over the previous bar's range. Bulls on parade. You had a little bit of a weaker look, as we know, at the quintuple bottom low, right at the weekly 20, with the close being there 2 weeks ago now. It's just not really in play as a neckline break. The one thing that we can say here, and it's why in the intro I said it seems somewhat more probable that the S&P 500 can stage a higher low, notice that the NASDAQ is a little bit further off of the all-time high. You still have the threat, in my view, that this might turn into a head and shoulders. Now remember, at the Trade Brigade, it's only a head and shoulders when it is, meaning that we do need to break down through the neckline, bring in the lower low before we start talking about bearish outcomes. For now, it's a little bit more of an equilibrium developing on the weekly chart. We can come in with the fibs from the same exact reference points from here to here. All of this is happening over the fib 38.2 bull flag consolidation from the April low up to the all-time high. This 38.2, slightly higher than the previous all-time highs here. So that monthly higher low is kind of a zone in here if the market does end up pulling back and breaking down through the weekly neckline, which as of right now doesn't seem like a huge threat, but we'll take that day by day. Let's clear this up. Let's take a look at our volume profile from the weekly and just get a sense of where we're at relative to this node. We have closed back above it. That is bullish. And once again, optimism is going to be your friend. Remember that the market belongs, the future belongs to those who are optimists, not really those who are pessimists. short windows where pessimism maybe makes sense, but in the market, especially at the index level, being an optimist is typically the more rewarding of the sides of the trade to be on. Let's go ahead and take a look at the QQQ daily chart and just see what we've got going on from this view. And the anchored view apps, by the way, would have been the same on the weekly view, just re-navigating over the entire stack. Let me go back, though. I just actually want to double check because we know the NASDAQ is slightly further off the high. Let me just not speak out of turn here. Let's check it. Yeah, we are over all of them, but by a little bit less of a margin, that's all. So anyways, that is a decent check back. I'm glad to have confirmed that and not just spoken sideways out of the corner of my mouth. On the daily chart, here is our expected move for the upcoming week. Upper bound is at 630.91, lower bound is at 607.59. What, right out of the gates, what strikes you as being different? Well, the lower bound is technically an overshoot of the top end of those bearish engulfers. From here, 1120, and here, 1010. Doesn't mean that it's still not a higher low. It is, and I would still maintain the same stance as the market on the S&P side. But here's the deal. If the market needs a big overshoot and we go here on the NASDAQ and we start to rally and we start to see some struggle there, I would look to short the NASDAQ, not the S&P 500. Right? So if you want like an actionable takeaway in terms of index selection or product selection, even what side of the market to be looking at, the NASDAQ, in my view, would be much more susceptible to this lower high to confirm building out sort of that weekly head and shoulders we were just talking about if there's a deeper pullback in the first place. If the S&P pulls back to the same equivalent level and screams back and does something that looks like this, above the level, that's a different story, right? So in terms of the trend count, you do still have a higher high. It's not as meaningful as the S&P 500. If you come in here with the trend line, there's two. You could that's your primary all-time high to then that anchor point. You could also come in and do something that looks like this, which is also broken on that Wednesday session and then Friday's follow-up. So you've broken trend line from that perspective. And in my view, I like the horizontals a little bit better. You do have the higher high. And most notably, I think if this market was going to roll over in a more meaningful way and just sort of like fake everybody out back to the downside, this Wednesday reversal underneath this 3-day balance range, that would have been the spot to do it. Imagine the look of the chart, right? You overshoot the bearish engulfer high and oh my God, everybody's bullish again, but you reject the 3-day balance range lows, come back in, fail the moving averages, and you're suddenly closing Friday down here. That would have been the ideal setup for the bears. And once again, I'll just sort of put yourself in the shoes of the sellers. It didn't happen. Friday's close up and inside of that 3-day balance range does strike me as a bullish takeaway here on the QQQ daily chart. So in a picture perfect world, yeah, consolidation would be above this for a sort of higher low and continuation, maybe a gap close overhead. But I still have to give the market here on the NASDAQ that equal benefit of the doubt and say, okay, is it possible? And, maybe we just look for something more toward the midpoint of this rather than going all the way back down to that Friday high. If we take a look at the hourly chart, we could probably see this with a little bit more clarity. Yeah, there we go. So see, you have a little bit more congestion here up against this level at 606. If the market were to pull back and fail this area, I would probably want to see the market no lower than that. It's still hard to say. You would still be having from here to here the potential for a higher low on the daily time frame. But I would think that this would be much more, what would you say, preferred. Now, does the market ever give you exactly what you prefer? Nope, you got to ebb and flow with the market. But 606, if it does happen, would be a beauty of a spot for a potential higher low to form. And once again, that's just simply using this Monday high as an area of support, from resistance to newfound support. You got a little bit of that action Tuesday afternoon, but it would make more sense if the hourly trend flips to down, maybe something that looks like this, to then solidify this as that daily higher low and then renegotiate an hourly uptrend to get back on track to do something that looks like this and possibly looking at the all-time highs as a potential target. So that's something that will carry forward here, in the QQQ NASDAQ. Let's check in on the fibs and the intraday anchored view apps coming from here to the high, fib 38.2. So beautiful in terms of confluence with the bull flag consolidation look if we support here and go. And if we go further, the 61.8 technically is that right spot as well at 596.50. So you could carry this forward as a line in the sand. But I really I would prefer the market didn't go there at this point. It's a little bit too deep of a pullback, in my view, failing underneath this level we just talked about. Let's come in here with the anchored view apps intraday. And what we'll notice here is a little bit more of a discrepancy between this upper band and this lower band. This is from the lowest low, and this is the engulfer high. So in a picture-perfect world, right, this just kind of supports, maybe there's inverted head and shoulders. The overshoot catches support at the all-time high and previous engulfer high anchored VWAPs. That's a possibility. And then you'll start to see, as the week wears on, as long as prices And I would have to imagine with, holiday volume here, getting back to regular volume as we enter this upcoming week, it's going to be easier to bend these not moving averages, but the anchored VWAPs, right? Volume weighted average prices. The more volume that can transact up here, I think the easier it will be to bend those in the upward direction. And the point I'm trying to get at ultimately is, do we just see support here off of that 606? And what's pretty compelling about 606, and we'll just jump over the NQ futures to take a look, is it's the round number on the NQ futures. If I take a look here, the number on the NQ futures is 25,000. What a nice psychological area for potential support. Now, do you ever second mortgage the house just because it's a psych number? No. But in terms of adding confluence to the level, the importance of the level, 25K NQ would be a hell of a spot for a nice daily high or low. If we're looking at the internals at the NASDAQ exchange level, really strong day on Monday. Look at those volume flows. I mean, screaming to the upside, well above 400 million. And you have to remember, on Monday, it's not like we opened on this massive gap up and everything's skewed where, of course, by being out of range. Because remember, this measures from previous day's close. If we open on a gap up, it's a little bit more obvious that the volume inflows will be substantial. You opened in range on that Monday session, and yet volume flows were almost double what we call substantial, stretching up into 800 million. That's a big deal. So you immediately saw sort of this U-turn as the AI trade fears got put to bed, and the Fed started to do a U-turn on their signaling of a rate cut for the December timeframe. In trend higher zone most of the week here. Cumulative builds all screaming to the upside, bullish at the exchange level. Ignore this sort of ramp. That's just a miscalculation by closure here. But you get the idea. Bullish in terms of exchange level participation. Once again, doesn't mean that pullbacks can't happen. A pullback would be the healthy outcome here to establish a new higher low, something that we can manage risk against. Let's just say, maybe risk and reward, generally speaking, as a zone or a theme or an area to start trading against as an idea into the end of the year, right? So that is sort of the upside there on the NASDAQ. Let's quickly take a look at the market profile. Any nuances that we should pick out of this? Mostly the same. I would argue that on the Wednesday session, sellers had a stronger opportunity to bring value back down towards that Tuesday unchanged mark. Notice that point of control is lower and the just value is unchanged from Monday. So sellers on Tuesday should have used that as a cue, so to speak, to maybe bring in a stronger pullback, trying to get back to comfort down here. Because remember, point of control is just where the market's most efficient. It's the highest volume node of the day. That's where the market's doing its job the best. You've got, it's most efficiently distributing contracts to buyers and sellers at a given price point. So the fact that there was no magnetism to that point of control, which is now just going to be a VPOC, tells me quite a bit. Once again, that sellers are not clinging on to any potential advantage that they may have had over the shortened holiday week's worth of trade. And the thing that will confirm this is, once again, where is the daily high or low? If we could just set a daily high or low, we've confirmed the reversal from the lows to a higher low, highs, higher highs. We're back in a daily uptrend, gunning for that all-time high. Let's jump on over to the IWM and let's see what's going on with small caps, where I think it's the most obvious for the Fed pivot argument. If you just take a look at this, this is the SPY. So let's go to the IWM. There we go. Let's go take a look over here. So this is, just right out of the gates, it's different, right? It's a green hammer candle instead of that red hammer candle. So that does mean that buyers took it back up to the opening print, through the opening print for range expansion in the upward direction and a really strong close at the highs of the monthly range. This is compelling because the previous monthly bar was actually an inverted hammer. You broke the low, sellers could not follow through underneath. So you could have even set a monthly high or low anywhere in here. I would have been a little bit more partial to that, and I guess it just is the lower wick. But you could have set this high or low on a red bar and then reversed out of it into the end of the year, December, and buyers are just like, already, nope, we're on top of it. Fed pivot is all set. Let's go see if we can run to new highs, right? So a big monthly base is sort of breaking out here on small caps after what was a failure in the month of October, getting some follow through and closing over the closing print of October as well here in the IWM. If we jump into a fib pullback from April up to the high over the 38.2, that does strike me as bullish. We could just quickly check in on that 20 SMA over the 20, 50, 200 is not even in view. Let's get into a weekly chart of small caps here. Scream and move back to the upside, back into this major overhead supply here. And this makes sense, right? The big rally there was under the premise that, the Fed's going to be cutting rates a number of times into the end of 25 and then early 26, looking for a Fed funds rate to settle somewhere just a little bit underneath 3%. That went away as the market started breaking down and you got really mixed signals from the Fed. It was almost like a communication breakdown from the Fed into the end of now 2 weeks ago. And they've sort of righted the ship and said, no. We're still like, although Powell said maybe it would be a little bit skeptical, we're still on par, or on pace, I should say, for a cut to end 2025. So the signals have come clean and clear from Williams, Waller, of course, Super Dove Mirren, and we'll see what we get this upcoming week. Powell is scheduled to speak on Monday night at 8 p.m. We'll see if he comes out and tries to reverse the course of this renewed optimism. But on the weekly chart, strong bar, everything looks good here. If we come in from the low up to this high, never really violated the Fib 61.8, all set from there. We can check in on our anchored VWAPs on the small caps over the entirety of the stack here. If we take a look at the volume profile on the weekly, we'll see, and this is fairly straightforward, we're over this node as well, back up into basically all-time high territory. So looking good on small caps. Let's take a peek at the daily chart and see how this reversal has unfolded. First thing I would say, and this is true of the other indices as well, but this was the expected move last week. You had like a 2, almost 3 sigma move outside of it. So really, really strong push in the upward direction on these renewed optimism sort of ideas from Fed members and speeches that have been said, interviews, the whole 9 yards. And just like the S&P, just like the NASDAQ, the only thing that buyers need to do is stage some kind of higher low, ideally anywhere over 241.65, which would be beautiful, right? We stage a higher low here, we're building acceptance higher, and then likely a monthly breakout, as we saw, right? This is a big monthly range. You get a flat top high breakout on the monthly over 251.75, stretching into new all-time highs, fueling what? The broadening nature of the market rally. Remember that the Russell 2000 speaks to the broadening nature of the market rally versus the concentrated rally that we see and get from the NASDAQ, which is over-indexed, I shouldn't say over-indexed, but maybe appropriately indexed on your heavyweight components like NVIDIA. So the broadening nature here is technically bullish for the S&P 500, which is a little bit more diverse than the QQQ NASDAQ 100, right? So 241.65 is slightly underneath the lower edge of the weekly expected move. Not unreasonable. It would be a 50 SMA hold, a 20 SMA hold, something that generally supports in here. Looks pretty darn good. So that is that. The trend has, sharply flipped back to up with this higher high, undoubtedly, over the engulfer high from here and the engulfer high from here, right? This really was not even the 1120 bar. This was back here. The strong move back above. You can see from a percentage basis, it's probably much further than the S&P. It's not probably, but it just is much further. That's a 4.1% move over the engulfer high. Let's quickly check in on the NASDAQ. NASDAQ seems to have about a 0.79% move over the engulfer high, and the S&P has a move of about, stuck in the middle with you, about 1.14% over the engulfer high. So one more time, it's very obvious here that the Fed U-turn has had a huge impact on what's going on with this market. We also are starting to get data again, which is influential to start to balance off, labor-driven cut, inflation-driven hold. What's it going to be? We do have PMI numbers coming out this upcoming week, which we'll talk about in just a moment, but let's take a peek down here on the hourly chart. Once again, a vertical move in the upward direction, undercut and rally here, just relentless bid underneath small caps on the Fed pivot back to being dovish. In terms of pullback levels, I think it's fairly straightforward. This would be the best one. It's the most shallow, some sort of continuation that looks like that looks good. Continuation just straight in the upward direction. All-time high level is really between, it's a zone. 251.75, 250.277 is the true all-time high. If we do pull back a little bit more deeply, this is compelling here. And once again, stage those higher lows incrementally to get back on the bull side and action on buying markets here for small caps. That's that. Let's come in here with the Fibonacci's from the low up to the high. Fib 38.2, right on the money with that key daily level here at 241.65. Again, like the other components of the broad market, could you overshoot that and still get a higher low? Of course. It just wouldn't be as compelling. So for now, because it's already underneath the lower edge of the weekly expected move, I would give that the benefit of the doubt at 241.65. Okay, that is small caps. Let's quickly take a look at we could go in here with those anchored VWAPs as well. Let's quickly check in. The clusters right here. So any pullbacks generally in this zone, bullish for the higher low. Let's get on over to the Russell side of the internals, see what the index level has for us here. Decent volume inflows on Tuesday, notably. That is where we had Hammock possibly being offered up as a Fed chair contender. That was released midday. Gold had a nasty but also interesting little spurt in the upward direction there. You could see that the advanced decline line, not quite as strong as the other indices, but not bad. Same thing over here on the cumulative build. All I would offer based on this information is that markets don't move in a straight line. Is this overbought? Is this overbid coming into a new trading week? Not unreasonable to think that, okay, a little bit of give back here is well within the cards. It's all about that higher low. Do we set a higher low in small caps? And if so, that gives us confidence to say, okay, we're not short the S&P 500. If the NASDAQ really falters and fails, maybe there, but probably not in the more diversified S&P. Let's jump into our market profile for the Russell and just kind of see where this lands. If we just zoom out here a little bit, there we go. You can see that the market is shifting value consistently higher. So boom, boom, boom. You can see here is even still higher, even though it's central in that profile. Then on Friday, much more of a normal distribution there, looking like that. So is the market getting tired? Is it possible that we need to tag up, so to speak, to some of these VPOCs? It's definitely possible. And once again, higher lows are the name of the game. But generally, there's nothing so deficient in terms of the market profile structure here where I would say, oh my God, watch out for this. Nope, kind of status quo advance with sort of thin structure underneath us. Let's get back on over to the platform. Let's take a look through our sectors. We won't go to monthlies here, but we do want to talk about some of the improvement that has been seen. So first and foremost, when we go through these, I'll sort of call them out, but please, as you're going through and maybe watching and thinking about this, always in reference to that Thursday engulfer high. Where are we, right? Semiconductors, the heaviest weight, most risk-on component of the market, check, above, looks good. Biggest performer this week, up 7.08%, that's huge. If we look at the tech sector, this is the only one of the 11 S&P sectors. SMH is not a sector technically, it's a subcomponent, but of the S&P sectors, this is the only one that's still underneath that Thursday engulfer high. Now, why is this important? Because it's the heaviest weight risk-on sector. So please be mindful of that on the XLK. If you really start to neutralize and get stubborn in this area, I would say the other sectors really need to be pulling their weight. Otherwise, we may not want to be chasing highs, right? Let's think about the implication here for the S&P 500. Do we want to be buying a rally into the all-time high, or under the context that the XLK has not broken here? Or would we rather let the market run into the all-time high, pull back, and then try to stage a higher low opportunity? If your XLK is doing this, then maybe poised for a potential break as and if it can stage a higher low here. So let's just say we get this is the XLK. That would be your optimistic future. And then in cyan, let's just say on an equivalent basis, the S&P is here. You don't want to be buying this blue dot if you're still underneath that 291.50. You want to wait for this higher low to develop in the, let's just go back with the white crayon perhaps as an illustration. Let this higher low develop in the XLK. Let it break this level. That hopefully coincides with this. And then I should just use the cyan crayon, my goodness. That coincides with when we want to be long at the all-time high in the index level product, okay? So just one way to think about this configuration as we head into this week. Let's keep moving here. XLY, certainly an impressive recovery. Look at where we're at relative to this high. Let's get back to that white crayon. There we go. Really nice move. And most importantly, not really rejecting. It's still possible. It's too early to say, but 263, at least on Friday, not a big rejection there yet. If this does roll over and die back for a lower high, it would then become the argument, right, just like the broad market, do we set the higher low here over the engulfer high from that Thursday? That would be a key component, 230.40, right, is the number there. Before we keep moving, notice that these are three of the heaviest weight risk-on components for the market. They led the rally in the upward direction. So when it comes to risk appetite, risk-on, risk-off, it's not like the S&P was led by consumer staples. It's not like we were led by energy. It's not like we were led by utilities. All of these lighter weight defensive sectors trying to push the market higher. No, this was driven primarily from the risk-on cohort. Let's keep moving. Materials, not much to say other than a nice break here. No possibility of a lower high, and instead higher low is the name of the game. Lightweight sector, so not all that meaningful. If we look at the XLF, trying to neutralize via an equal-ish high, I would just say the lack of sellers providing a lower high under this, lack of sellers providing a lower high under this, just can't remain bearish here. I might be a little bit more neutral, not outright bullish, but definitely not bearish or as bearish as it could have been if this bear flag built out underneath 52, trying for a daily 200 break. The fact that we're above this and actually back above all the key moving averages in here does strike me as a nice recovery effort. If we look at utilities, nice breakout from this range in the upward direction. Nothing bearish to say about that. Industrials over the Thursday engulfer high, midpoint of the range still. This general range hasn't done much, but it's not bearish, right? The sellers could not keep prices for a lower high underneath. That's good. If we look at communications, another one, here is your high of the engulfer. Nice move in the upward direction, reclaiming the 50, the 20, and also right at the trend line, I believe. Yeah. So the idea here is if we get a pullback off the trend line, this on an equal high reattempt in short proximity of time, but more importantly, coming from a higher low, this here, that stages the opportunity for a breakout, which in theory starts the trend back in the upward direction, which would be bullish for the market, remembering that communications are a heavier weight, not top four, but heavier weight risk-on cohort. Let's take a look at staples. Really strong movement over here. It's not nearly out of the woods. You still have all of this overhead supply, but I will give credit where credit is due. If you're a seller, you wanted to see the lower high here and crash and burn. Just not the case. And you could think, as funny as it might sound, Macy's, big move. They have earnings actually upcoming, but it was KSS, Kohl's on earnings. Big gap and go in the upward direction. Your retailers honestly look pretty good. TJ Maxx, Walmart, right? These things look pretty good. The chart that does not look great is honestly your cost. Your Costco here is still in that aggressive downtrend for XLP. So when it comes to those staples, the apparel, like again, TJ Maxx, Macy's, Kohl's, like these things, very kind of interesting that they're performing so well. I don't really think seasonality is enough of an excuse headed into the holidays looking for the uptick. But anyways, XLP, it's not hurting the market. We could say that. Real estate still stuck sideways in this 7-month balance range. I suppose lower rates will, of course, influence this higher. We've been looking at this XHB recently, which, of course, looks good on the break of the trend line here, 50 SMA, lower interest rates around the corner. You could go to Toll Brothers. You could go on over to something like your Lennar. These things look great. Nice breaks there. Even mortgage companies. We've been talking about this a little bit with the group, but something like Upstart, honestly, off these lows, if this can stage a higher low, you're sort of bottom fishing. It's not the greatest looking one, but maybe like a Rocket Mortgage looks a little bit better here. A higher low over 1850 on a pullback. Not bad, right? So let's continue along. We talked about real estate. Let's go healthcare. Another one that's just been on an absolute tear in the upward direction. This is historically a little bit more defensive. It's also been really lightweight. With the move back in the upward direction, I'm honestly curious to see how much market cap and market share recaptures, and if it's going to rebalance towards the top end of S&P weighting. If we just go over here, healthcare has now moved to 1, 2, 3, 4. So it's still a fifth in the lineup there. Remember, it used to be the second heaviest weight sector by market cap, which is just so interesting. To see it back at the all-time highs, I wonder if the rebalance will bring it back up. So anyhow, XLV, risk on. If you look at something like the XBI, definitely breaking out here on the Fed flip-flop back to bullish. But really, through all of the turmoil, you never really had a big downtrend in here. This was just like a steady grind in the upward direction out of biotech, which once again, to me, aligns more with the bullish opportunity into the end of the year. You could still get a pullback. Like the time to be buying this is not literally smack on the highs here. It's after a phase of consolidation or something like that. But the point still stands is that it's not as risk off of a market as it may seem, perhaps. Let's continue along here with energy. Nothing really write home about on energy. Crude has really been struggling the last little bit. If you go to CL, it's still stuck in this little downtrend here underneath the resistance trend line, underneath the 60 handle, honestly. Just kind of tangled up. So we'll see where that lands early this week. Let's go to bonds quickly. No reason to sell any puts yet. We haven't made any move lower, and I don't know that we will, given what's going on with the Fed at this point. Let's jump on over into our ratio grid and see what's happening from a sector ratio perspective. If you're not familiar with the ratio grid, check out the video tutorial in the top right-hand corner. The glue is at least going sideways, but it's not risk on from a ratio perspective, which is kind of funny to say. If we look at financials, stabilizing, a little bit better. Not great in communications, not great in discretionary, although these things did see upticks off of the lows. This kind of neutralizes my analysis a little bit. Pretty optimistic about the chance for a daily higher low. But if we look at the market performance here, I would really want to see the short-term charts on these ratios in the sector level start to reclaim their daily 50 SMAs. Healthcare looks pretty good here as a nice improvement. This is at least not risk off on staples, and utilities pretty flat as well. So a mixed bag when it comes to saying like firmly risk on, but if we look at those charts, right, they are in the early stages of improvement on the structural charts rather than the ratios. Starting to see some recoveries here. It would be very interesting if these just are total, like, the way to frame it would be an undercut and rally of the 50 across the board here, something that looks like that. If these charts develop like that, then my goodness, there's no reason to fight this market. Now, if they roll over and make equal lows like that, now, okay, that's a totally different story. And I would start thinking about, wow, is this just a fake out into the end of the year, this little push? So far, it's on a stable footing with that SMH up 7.08%, right? That's risk on. That speaks to pretty good confidence there, along with some of the breadth and broadening nature that we see in the Russell, as well as some of the additional indications we'll get to. But that could go out the window if these things start to roll over in a big way. And I do still have some concerns. Like NVIDIA doesn't look great. Palantir doesn't look great, right? Some of those AI darlings are still kind of on the fritz. If we take a look at the B set, not bad over here. Gold trying to stabilize rather than continuing to pummel the S&P. This looks like a potential breakout there, which would be bullish for risk appetite. And Bitcoin trying to stage a little bit of a low, but it's kind of in the middle of nowhere. I don't quite trust Bitcoin yet. Still looks like a lower high opportunity to me before, I would start really averaging into Bitcoin, looking for continuation into the end of the year, regardless of what Saylor says about Bitcoin going to, I don't know, what's his target into the end of the year, 250K or something like that. Let's get into where do we want to go. Let's go dollar and rates, kind of flat and stable here. I think the Powell commentary on Monday night might offer some interest here. It's probably not going to be on manufacturing PMI Monday during the day, but maybe services PMI on Wednesday. We'll get to that calendar in just a moment. Let's get into the inverted ZT. Moving back lower, there's a contract roll in here, but moving back lower, improving the odds for that rate cut. If we just jump back on over to the platform here, take a look at the Fed Watch tool. Remember that these odds have flip-flopped in a crazy, crazy way. I think we could let's go to current, and then let's just see how this comparison is going to go. So, yeah, really not that great on this compare. It's just because of the way that this is put off. But we had this huge flip-flop, right? And we've talked about this for a little while. We used to have like 70 to 60% odds of a pause. Then we went back to odds of a cut, and then back to a pause, back to a cut, right? So this Fed volatility has really driven some of that Russell volatility and the broadness of the market rally on the move back to being slightly more dovish. Once again, we'll see what JPOW really has for us on Monday after the close. Speaking of the calendar, there he is. I believe it's some form with Q&A. So there should be Q&A for those pajama traders. You'll get a little bit of volatility in the night session. ISM Manufacturing PMI, not as concerned about this, but rather this one here, ISM Services. That's Wednesday at 10 o'clock intraday. We'll watch to see how that comes out. Not as concerned about services final from S&P Global. ADP non-farm should be interesting at 8:15. And then as we move into the end of the week, on Friday, we will get, of course, our, I shouldn't even say of course because it's been so long, but the PCE inflation measure. We'll see what that is. And that should be, yeah, this is going to be an old report, so I don't think the market will really care about this all that much. It's probably more about the consumer sentiment and inflation expectations from the University of Michigan folks. We'll see what happens on Friday morning. So those are your upcoming things, and then just remember the following week, which is kind of interesting to me that Jerome Powell is speaking on Monday. I don't know. I would think the blackout period's at least a week, but I guess that would be Wednesday of this upcoming week. We will have the FOMC, right? So this is absolutely something that should be on the radar, where we'll get more information, and primarily this is what we care about, the updated SEP, where Jerome Powell and all the henchmen vote on where they think policy should be as we walk forward. So that's kind of a forward-looking view of what the economic calendar has for us. Here is the earnings calendar. Not much to really pay attention to. Maybe Mongo on Monday after the close, although they're not really in, storage, database, sure, but not really storage like your MUs and SanDisks of the world, two totally different things. Might just kind of be interesting. We'll see. Marvel, Chipmaker, CrowdStrike, interesting. Pure Storage, definitely more so on the cloud side there. Interested in that. As I look forward to Salesforce, I think Salesforce is bearish, honestly. Snowflake will be interesting. C3AI, it's not really been a big player in the space, in this AI race, so to speak, or at least market cap wise in terms of what the chart is doing. Kroger could be interesting, and then maybe I'd give an honorable mention to Rubrik, Sentinel, and possibly ChargePoint. We'll see if that comes back and what that looks like for the EV space. All right, that's it on the earnings calendar, sort of going through it in real time with you there. Let's take a peek over at some continued supporting evidence as we look at bonds relative to themselves. I like that this is neutralizing. If this continued in a stronger uptrend, it would tell me that inflation is more of an issue than the Fed is maybe letting on. But the fact that it's neutral strikes me as being okay. As we take a look over at credit spreads, coming in a little bit, primarily looking at the lower and just saying, okay, this looks decent underneath still a rising 50 SMA, but if this can cool off, it would just indicate a better and stronger risk appetite for risk assets, really, like equities. Let's jump into junk in isolation, and this does look really good next to the SPX here. We've had some really, really strong reads out of this in terms of keeping us from being short in the hole. Remember, this bullish divergence here told us, hey, you could look for a lower high, but shorting in the hole is a bad idea. Notice how this is continuing to rip higher here as the market's also ripping higher, just confirming the move that we're seeing. So in my view, I really like what junk is doing, and it's telling us that risk appetite has improved dramatically as the Fed has sort of pivoted back to a much more dovish stance. So, I mean, that means we are probably subject to headline volatility if a Fed member comes out and says opposite, right? Something to keep in the back pocket. If we're looking at market breadth, and I would love to have a more opinionated stance on what should be going on with the Fed. Let me be clear about this. I would love to have that stance if I had a little bit more confidence in the data. I almost feel like Jerome Powell saying, like, it's really hard to make a call as to whether or not we should be dovish or hawkish because we just haven't seen the data, right? As I look at the ADP non-farm numbers, as I look at some of the numbers from the ISM reports, I tend to lean a little bit more on the side of like, let's not bring rates to zero. Like, let's not go super dove mirroring, maybe a little bit of easing, but nothing crazy. So I'm probably more hawkish than the Fed personally, but that's just, I haven't seen inflation numbers, really. That's the issue. If inflation's fine, then fine. Maybe rates do belong a little bit lower to maybe keep growth, but Growth is not part of the dual mandate. Anyways, those are my 2 cents there. I do like the breadth improvement. This shouldn't really shock us, noting what's going on with the IWM. So this does strike me as being bullish. If we take a look at RSP, just a little bit of a cleaner chart up top now, breaking the top end of the trend channel. So from the bottom to the top, I mean, just hard to be a bear when breadth is expanding like that. You can see the same thing in the equal weight NASDAQ. It's maybe not all the way to the top end, but it's at least improved over the bearish engulfer high, which is the notable measurement point at this point. Let's jump into volatility, getting crushed here back to the downside as we take a look at VVIX. Obviously, we'll see something very similar, getting crushed well beneath that 103. And the most important tell on volatility always is your backwardation versus contango. And you can see here, strong contango is getting even stronger as the holiday week paired off. You can see the same thing here, 9 versus 30 day. The next key signal will just be if the one-day VIX hits 745, which would indicate that maybe the volatility storm is coming more to a conclusion rather than, oh, we're only halfway there, right? Nope, it's probably over at that point. Let's jump into some of these charts. So what I find really interesting is that the market is performing quite well with NVIDIA well off of the highs. Like, let's not forget, this is a substantial move from the all-time high to the closing price here on Friday. You're off 16.5% in the heaviest weight company in the market, and yet the market's like trading here on an equivalent basis. So remember I said to use that Thursday high as a metric or a gauge. NVIDIA is clearly displaying relative strength, and I do not think the S&P 500 would be in nearly as good of a position if we did not have this Fed U-turn to being back more on the dovish side of the equation, trying to lift some of those smaller companies. Not that they're intentionally trying to lift them. I'm just saying that's the result ultimately of the dovish stance, getting those things to move in the upward direction. So the broadening out is what's keeping the S&P alive, which is why, once again, there's no reason to be a short in the S&P. You would want to be a short in the much more narrow and concentrated NASDAQ if you're a believer that no, NVIDIA down 16.5% is still a problem. So lower highs here are a problem. We're inside this consolidation. You could start arguing left head, some sort of right shoulder builds out. I would really only get very bearish on NVIDIA if we were underneath this zone down here, 165. The chart does not look compelling to me by any stretch of the imagination. There's no real strong setup on the daily chart here. On the hourly chart, you don't really see much either. You could maybe say something like this, but I mean, that's still a problem. Like, you'd really have to start building out some new compelling structure over 184.75 if I was going to lean into this on the bull side. So once again, maybe this neutralizes a little bit of the bullish tone we had for the S&P because it's still the heaviest weight component. But it's just like this chart there's nothing to do on NVIDIA, which is unfortunate because the options market on it is deep and wide and there's plenty of liquidity to go around. Anyways, what's happening with our good friend Apple looks really strong. Look at this breakout into the end of the week, multi-day balance range in here. I think this is a top watch for continuation into blue sky territories. All it might take is a little bit of a spark about Black Friday deals. How did the sales go? What was Apple doing in terms of revenue over the weekend? How are iPhone sales doing? Anything like that as a positive catalyst over the weekend could be what sends it up and into blue sky territories, targeting this overnight all-time high at 285.45 and possibly beyond. Apple has displayed incredible relative strength through all of this market sort of volatility, if you will, even the 1010 engulfer from back over, where is that? Sorry. 1010 back over here, not getting any, we look at the 1120 versus the 1010 engulfer. Right, this is like a completely different chart than the broad market, right? So great relative strength. I love Apple's chart. I would love to look for some kind of compelling break of this as just a high tight flag on the hourly chart up and into blue sky territories. Let's take a peek over at Microsoft. Let's go to that daily chart first. I'm interested in Microsoft, and I technically have a long on in Microsoft. I'll always try to be transparent when I do have a swing position on. I've got swing shares on Microsoft, long from somewhere in here. I would have to double check my average, low 80s, 480s. So I like the concept of the hold off of the weekly pivot here. The one concern I have, which is going to be, we're going to learn something early on this upcoming week, is whether or not this, right? I think I've said it in the channel before, but we're between a rock and a hard place. You've got double top on the weekly as a neckline here. Remember, markets typically belong to the optimists, especially in solid companies. So if we could do something that looks like that, I would be much more willing to add to Microsoft. It's kind of a starter position here. It was smaller than Amazon to start. But if we could get over this neckline, I'd be much more compelled for upside. If we just kind of reject and noodle around in here, I would want to see if this can turn into a weekly double bottom and then take it from there. In terms of immediate indications on the daily chart, yeah, we've got a screaming move in the upward direction. You've got a barreling down 20 SMA. Nice hold of the daily 200, but it's very possible you could pull in and set a higher low here. That's what I'm really looking for on the daily chart as kind of a line in the sand around this 476.60. It would be a gap close to the, what would that have been, Tuesday high? Gap close to Tuesday's highs, Tuesday's close. If we get something that looks like that, you start building out higher lows on Microsoft, then great. This is now a daily double bottom, and instead of being scared of the weekly neckline here, I'm more compelled and optimistic about a double bottom neckline being compelling to the upside over something like 493. So that's really how I'm looking at this chart walking forward. There is quite a bit of overhead supply here, so I'm not trying to be overly optimistic, maybe sort of recognizing a little bit of the bias there on the, holding a long position technically. I wouldn't say it's wrong to think that this could easily just yield a lower high on a retest of the neckline under the 20 SMA. So very, very reasonable that the market could pull back here. In my view, it's just a matter of this renewed optimism around AI, 200 SMA hold. I mean, when's the last time you were able to buy Microsoft at the daily 200 SMA, right? You're talking about this gap up through it on the April tariff lows. I mean, I don't know. It seems like, at least if not just for a trade, right, a nice little opportunity there. So not to spend too much time on it, let's keep going. Let's take a look at Amazon. Amazon, I'm also net long. I still have shares positioned in Amazon as a more than just my normal long-term allocation to it. But long off the daily 200 down here, this thing has worked beautifully. I trimmed half of it there and just riding out the rest to see where we can go with it. I would ideally like to see the top end of the range, navigating back up towards here, then reevaluate. Is it worth trimming? Should we hold? Is it going to go through? Like, all those questions need to be answered in real time. But as we walk forward, there's now plenty of room for a daily higher low well above cushion here on Amazon, long from 218, like right in here basically. So much room for cushion on a higher low, giving it that daily 50. 227 is the ideal spot. If you look at the hourly chart, you can kind of see why. I mean, intraday rejections, and resistance. There you have it. New words are made every day here, folks. You've got 227. Can we hold the higher low above? Can we get that follow through to the upward direction? I mean, just a great looking chart. And, really, it's the same idea on Microsoft as it was Amazon. Can we get something off the 200 for a counter trend move? And does that counter trend move develop into something more sturdy and strong, something with some more staying power? So that's the short-term look here. Ideally, it's 227 on higher lows. If it drifts higher, I would expect a negative reaction, a bearish pullback off of 238.75. Let's move over to Google. Google's got great relative strength, obviously, with their TPU story really becoming a contender to NVIDIA. 3-day balance range up here at the highs. That looks great. I don't know that we have a breakout setup yet. We'll see where that lands. But what would be great early in the week is this, to then get to the overnight all-time high. If we break down from this, I want to be very open-minded to a possible higher low here over the previous 3-day balance range high, and also, does that align with, at some point in the future, a 20 SMA hold? That would look pretty good on a gap fill reversal at 304. So Google, great relative strength, just like Apple. I would love to see this consolidation continue to work in the upward direction, just bolstering, not only intraday trading opportunities over 327.50 up to new highs and so on and so forth, but long-term positions held in Google, much more of just like retirement account size positions, and, not any kind of like bolstered up swing trade or anything like that, but just liking the chart here, liking the relative strength. I'm liking it emerging as a new AI leader. And I think as long as this stays the case, as long as this is a new AI leader, thematically from a narrative and story perspective, then we'll be okay with NVIDIA kind of cooling off and maybe passing the baton for a new growth opportunity. Let's continue along. Broadcom, another beautiful looking chart here. Great breakout of this range. It was so frustrating in this range. It was quite frustrating to see it come from the midpoint, have its best day, and then just kind of follow through slightly on holiday volume. I'm interested in some continuation ahead of earnings. Any pullbacks for higher lows, really looking at this as a top opportunity, as something with relative strength, breaking out of a multi-week base, multi-month base at this point, with the opportunity for follow-through in the upward direction, tying into that Google TPU story. Let's continue along with the metaverse. And there's really, there's no hourly structure here to really read into. It's the same daily levels, right? There's no special little insight to glean from the hourly. Let's go on over to the metaverse. And I gotta remember to kind of keep it fast. We got 15 additional charts to rip through. Metaverse, I'm not quite convinced on. This is not a 200 SMA hold. It's had a really sharp rally off the lows, so I have to give credit where credit is due. But this chart, to me, the trend-wise, is much weaker than your Microsoft and your Meta, and that's just because it hadn't done anything in here for quite some time. I think that the ingredient for Meta is to sort of wait for the earnings cycle where they say, okay, we're dialing back CapEx, and our free cash flow is going to continue in the upward direction, or it's going to look improved, basically, right? And from there, maybe you get some kind of gap up on earnings, and it just seems like every time they talk about building out a data center, the company can't get rewarded, which is fine. But for now, as long as you're under that 200, as long as the earnings gap down is still in play, I'm a little bit more hesitant to try to long this versus something like your Microsoft or Amazon. So if it can build out a higher low, I mean, I'm not going to fight it, and maybe we go inverted head and shoulders, but I'd still be a little bit more cautious thinking about overhead supply on Meta versus those others so far. So those are my 2 cents on Meta. Not long here, no position on it. Intraday, it's been a little bit of a tougher one to trade. It needs a split, right? Maybe renew some interest in the options market for it. But so higher lows, right? Can we get a higher low here? Does that play? Do we get something that looks like, let's try that more reasonably like this, and then a reversal there? That would be playable as well off that 604. So those two things, if this continues to grind, it's probably really tough to capture in that earnings range off the left. Tesla, another chart that's looking pretty good on what has thematically been one of the more relevant setups of the month, to end the month at least, and we'll talk more about this in the 15 additional ideas, but this concept of look below and fail. You look below this huge overhead balance range, sellers can't yield the lower high for continuation, even through thin structure. Remember, there's nothing here off to the left. Now we're back in range. So what's the idea? We probably target the top end of the balance at 470.75, right? So higher lows over the junk drawer low, it's 412.50. That's why that says JD. It's the junk drawer. Higher lows in there solidify the look below and fail, and then we rotate up to the top. So I'd be much more partial to the bull side on Tesla as long as we're over 412.50. On the hourly chart, not much to really read into here. A little sloppy with that sort of shortened holiday session on Friday. Just generally, once again, pullbacks into this zone, equal highs. You could then wait for some sort of like equal high breakout that looks like that. That's possible. A reclaim of 440 would be a nice move as well. If you look on the daily chart, remember this balance within the balance, right? So that's Tesla. Let's continue along to JP Morgan. Financials making a nice move to the upside in the banks. And honestly, I don't know if it is in the trade idea, so I'll hold off on it for now. But there's one bank that's really setting up nicely for a possible all-time high breakout that did not go with the Goldman Sachs all-time high breakout, which was here, right? So that's JPM. Bullish until proven otherwise. Palantir, very similar to your NVIDIA, not out of the woods. Palantir is not over that Thursday engulfer high. It still has a big threat for a lower high underneath 171.25. These, this NVIDIA and it's really just Palantir and NVIDIA. These two charts are the ones that kind of keep me a bit cautious from over-indexing the bull narrative on the S&P. These are just such big performers in the story of the market and the AI trade here. So cautious of 171.25. If we can rip through that and set a higher low, it's a little late to call it look below and fail at this point. That was a pretty successful breakdown on that Thursday session here with follow through on the Friday, moving much lower than many other names, not just like a brief undercut and then go. So it's got to be 171.25. You have to watch that. I would respect the opportunity for a lower high here on Palantir early on in the week, especially if the broad market's going to see a little bit of a pullback. That would make sense to me here. Let's move along to AMD. AMD looks good for this is much more of a look below and fail. It looked into the gap range twice and has resolved higher. There's a thin structure retracement over this little neckline. If you take it on down to the hourly, this becomes abundantly clear. Right here at 216, something that looks like that. Yeah, not unreasonable into 226.65, looking for some follow through out of AMD. When we get there, that's probably a spot to be open-minded to the semiconductor story changing. If we reject, then okay, the writing's on the wall, right? A little bit of a double top under the neckline, lower high here after a Brigade bolt to the downside, sure, right? We'll be bearish then. But for now, failing into the gap twice, I would think that some counter trend could develop over 216. Let's continue along to Robinhood. Talk about a major look below and fail. Remember that something might be successful. You could call it a successful breakdown when you actually double the range of the pattern. You hit the measured move of the pattern you're coming out of. So this is the double top, right? 1 and 2 neckline here. So you would try to double this range, but in the downward direction, all right? That goes like slightly off screen here towards, let's just call it 90 as a range double. You made it like halfway. So look below, fail. And at this point, any higher lows over the double top neckline, DTNL, at 120.50, keep bulls on parade. Right? Why? Because now instead of having overhead supply weighing on this for a lower high underneath, buyers say, no, these sellers are trapped. The story on Robinhood's still valid, and we'll move in the upward direction. For anybody who's been keeping track at home also, I had short puts on Robinhood at 80. Those got taken off for like 50%, and then I think it was 65 and 72 or 70, low 70-ish% of premium collected. I sold those puts on the big down day over here. Not like a home run trade, but anyone who's pocket watching, there you go. That position's done and closed. So Robinhood all set on that. Let's keep getting into some additional ideas. There's a lot of them to cover today. So let's go AAL, which is American Airlines. Take a look at this flat top high in here around 14 bucks. If you break out over that, you've got this big base that you're emerging from. Let me actually just clear this drawing set. This looks pretty darn good. Something over 14 on this American Airlines, not bad. Coming out of this balance range here with a lot of thin structure off to the left, a target might be something like 16. Now this brings up the point, like, okay, this is a pretty slow mover from 14 to 16. All you have to do is maybe go to DAL. Let's see what DAL looks like. Okay, so this looks a little bit better. You're talking about staying over something like 62, 65. And this DAL is not an additional idea, by the way. I'm just talking about the theme or the nature of the group. This moves a little bit better. You could go on over to something like UAL. What's UAL have for us? This one doesn't look as good. You're not breaking out through a flat top. Let's go to maybe LUV and see what Southwest has. Not as good. I would take a look maybe over at, oh goodness, what's Spirit? Spirit Airlines, what is that? Spirit. I have no idea. It's not coming to me right now. Spirit, Spirit. Spirit. If I could type, that might help. It'll come to me. You guys can probably roast me in the comments section for not knowing that one, but that's fine. So Spirit would be one to maybe look at, and that's sort of your airline trade idea. But the one that really stands out to me as being clean is AAL. AAL over this flat top base in here. Nice little nuanced higher lows as well coming into it. It's not like we're coming from, lower highs and lower lows. No, nice little uptrend behind us. Now it's just a matter of can we get momentum through this thin structure. So that's 14 to 16 AAL. Let's keep going here. Let's try to save a little bit more time on some follow-up here. Remember, I just said a moment ago that the look below and fail has been a huge chart theme recently. Look at this LUMN energy. This is a head and shoulders, right? Under the neckline here on that breakdown, but does it sustain? No. So any higher lows over 90, you have look below and fail, probably target top end of the range. You could even use this as a little bit of a reclaim up and over that 113.25 on BE, something that Brigade bolts here. I'd like to see some balance build first, then on the hourly chart, you'd call inverted head and shoulders and then go, right? So that's an idea, but BE looks pretty good on two outcomes, either this and support again, or build and then break. Right, so those are your two outcomes there on BE. Let's go along to BMY. Drug making space, of course. We know that the XLV looks great. You are right at the daily 200 SMA, but look at this downtrend break. You've broken that, and the reason that this is on the radar, and we talked about this with the group on Friday, is it does have a higher low. It's already got a higher low. We're pressuring the 200. You're over the 20 and the 50. The 20 is oriented properly to the 50. Does this get follow through like up and over about 50 flat as just a price point? Right? Can we start getting in gear here? What I love about it is, once again, the higher low and then how tight this setup is getting here at the 200. I know it's holiday volume, so we'll see where it lands early next week, but can we build out some setup and get a move in the upward direction? BMY, not bad there. You could use an MRK as a similar looking chart, probably even cleaner on MRK. Look at those inside bars. That's a bullish 4-bar play up here. You could probably use Lily's too far gone. This thing's just too extended at this point, but those two look good. J&J in the theme as well in the group, not bad. Seeing a bit of a hammer up here also. So that's BMY. Let's take a look at Citigroup. Citigroup, I was mentioning a moment ago how there's a specific bank out there that looks pretty good. It's because it did not fail in this move here. It's still just building out the base. So if Citi can build and break up and over something like, I don't know, maybe 105 as a possible breakout point, you're talking about, that's a bit more of a jump than I was anticipating. But over 105 gets going, and it's probably, higher lows over 103. If you wanted to use that at 103 as a possible entry tactic, build out a little flag here and then go. Looks pretty good on Citi. And remember, it looks much better than something like your GS. Goldman Sachs, which we know had a historical failure here on that failed headline. So I would not try to re-long this on the break, right? So Citi is the place to be there. Let's go to Coinbase. I gotta remember, there's 15 of these things to get through. Lower high, very straightforward. Lower highs underneath this 291.50 looks bearish, trying to send it back down to the lows. I would say that MSTR is the weaker of the crypto names. Look at this failed gap up on Friday. Remember that the broad market screamed higher. So the fact that strategy is not performing, look at this strategy just dump overall. If this can take out the lows at 166, probably looking for downside into something like 140. That's MSTR. Let's go to EOSE. EOSE was a big failure up on this break, but once again, think about the chart theme here. This is back over on a look below and fail, the neckline of what could be considered, let's try that again, double top. So any higher low here, and this looks very similar to what we talked about on BE, LUMN Energy, right? So that looks good. Possible entry tactic. Oh, it's got to be a higher low. Need to just set a daily higher low over 1355, and then maybe we navigate back up towards the highs around 1925. That's a possible idea, right? So that's look below and fail on EOSE. HIMS is not set up for it yet, but it is the next one on my list. So you can see I've got the alert here. Big balance range overhead. Is this going to go look below and fail? Are we going to rotate back in towards the top? I mean, the healthcare sector has been on fire recently, paired with retail doing well. We talked about Walmart, Target, maybe not Target rather, but TJX, as well as Macy's, Kohl's, just in terms of like people willing to spend money, right? So is this going to reclaim and then go? It's certainly a possibility. So that 4150 is looking pretty interesting to me on HIMS. That'll be something that I have in the back pocket. JMIA is another one here, which has really caught a bit of a bid over the last little bit. This has broken a trend line here. You're over or right at this high around 13. So can that get in gear to the upside? I wouldn't trade options on this. I would definitely be a shares trader. And also look at the weekly chart on this one as a cup and handle. Look at that. Really, really nice on JMIA. The other, only threat to maybe keep in the back pocket is that this is, it's got a lot of work to do. It's not like free and clear of everything. A good upside target might be something around like 1875 as a possible upswing. All right, so that's JMIA. Let's get back down to a daily chart. Let's keep going. Speaking of that retail, let's go KSS. Kohl's on the inside candle here. Bullish 3-bar play. Hard to chase, so extended, but nice move out of the base. And we'll continue to watch for any higher lows over 20 on KSS and whether or not this higher low trajectory continues to keep itself up. For the most part, I would watch the inside bar play early this week. You might be able to catch a quick momentum trade on the long side over it, and I would probably opt for shares here and not the options on Kohl's. Let's go to LUMN. LUMN is the ticker over here. LUMN, you can probably see where my head's at with this one. What did we talk about with Bloom? What did we talk about with EOSE? Is this going to go look below and fail on this previous level from the low at 815? Shares only on this. Counter trend move through the thin structure. This stuff has been working very well. If you want an example of this, you could probably take a look over at CLSK, Clean Spark. Take a look at this over here, right? This is kind of the breakout level where you really accelerated from. That's that high volume day. You looked below that level, you failed, and buyers are running away with it in the upward direction. So CLSK has done it, and that LUMN trade, LUMN, I don't want to say, it's got to be the same exact thing, but you've sort of looked below. If it fails, I would think you get some squeeze up through this. And, I mean, that's not a small move. You're talking about, if you do it with shares, right, you're talking about maybe, 40% if it goes back to the highs. Not claiming that you get all 40% of it, but that's a pretty good opportunity in front of you in terms of a range to possibly trade for. We looked at Merrick already. I do want to move along to Netflix. Netflix is a big idea for a possible lower high. You've broken down from this as a distribution. You could use classic Wyckoff, or you could call it a stage 4, whatever you want to call it. Lower high underneath the overhead supply. The split was not enough to entice new money to come into it and really preserve this upper balance. And instead, you've lost all the moving averages. You're underneath this. It looks to me like a great bear flag underneath 108.50. So Netflix is on watch as a short for potential breakdown into this 99.75 as the double bottom neckline from way back over here. Next up is ONDS, which is another retail darling as of late. A little bit harder to call it a look below and fail. I mean, this was maybe equidistant, a little less than equidistant underneath, but getting choppy and trying to build out, in my view, what could start to be seen as inverted head and shoulders. I like how this is trying to balance over the 50 and these prior highs. So if this can get a nice move up and over the alert, something into this 1150 area, those prior highs, it's made a pretty nice linear move in the past. Let's see if it can do that as we move into the near-term future here. So watching this ONDS over something like 875 on a potential break. And then last but not least, SYM. SYM with a beautiful inside day here after an earnings pivot, breaking over these prior highs. This is a little bit pricier, so let's get rid of that over there. Let's do this. A little bit pricier, and I can't remember actually if this is new all-time highs or not. I think it is, but let me double check. Let's go max available. Yeah, this is brand new all-time highs. We're looking pretty good here on SYM to new highs. And once again, the idea is if this can build out something nice and tight, which it's already starting. Friday's that shortened half day, so maybe give it a little bit of skepticism to start. But if we can build it out nicely, something over something like 87.40 into new highs looks pretty darn good. So that was about 15, maybe plus or minus 1 or 2 trade charts or chart setups that really developed over the span of last week that are probably interesting and worth keeping an eye on. Not all of them are optionable in the way that you would trade them with options, but some of those shares trades are still offering pretty percentage returns in terms of a range that you can actually capture. So that's going to do it in today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we'll be live at 8 o'clock Eastern Time every morning here on the channel. So we'll be back at it on Monday morning with another installation of the pre-market prep. I hope to see you there. Hopefully you guys had a fantastic holiday week, enjoyed time with friends, family. If you're not someone who participates in Thanksgiving, hopefully you had a nice break from U.S. markets and could enjoy the time nonetheless. I'm super thankful for all of you who show up and enjoy the analysis, leave thoughtful and constructive feedback, bring your own analysis to the table. I'm super thankful that we have a community here who has continued to support one another in the sense that there are a number of traders out there that I know and have talked to personally in the community who have developed really strong skills and discipline through the network here, positive reinforcement, and just really strong stuff. And I guess all I would say is keep up the great work. I am very, very thankful to have been a part of this all, and it would really not be what it is without each and every single one of you. So with that, I hope you enjoy the rest of your weekend, wind down the holidays, and let's get ready to hit it hard on Monday. Have yourself a green trading week, and as always, I will see you in the next one.